Let's dive right in. Where should you put your money, stocks or real estate? It's a classic debate, and the answer isn't one size fits all. I've invested in both, seen the highs and lows, and today, I'll break down the 5 key factors every investor must consider: returns, liquidity, risk, capital needed, and passive income. Forget the hype. This is a real, side-by-side comparison. By the end, you'll have a clear framework to decide which path or combination fits your goals. Let's get started. First up, returns. Historically, the S&P 500 averages about 10% per year, thanks to the magic of compounding. Real estate, on average, appreciates 3–5% annually, but here's the twist: leverage. With real estate, a $50,000 down payment can control a $250,000 property, so a 4% gain on the property is a 20% return on your cash. That's the power of leverage. Real estate can amplify your returns far beyond what stocks offer, even with lower appreciation. Stocks grow steadily, but you're using your own money. Real estate lets you use the bank's money to build wealth. It's not just about the percentage, it's about the return on your actual cash invested. That's a unique edge for real estate. Next, liquidity. How fast can you get your cash back? With stocks, it's instant. Sell with a click, and your money's in your account in days. Real estate? Not so much. Selling a property takes months, involves agents, repairs, negotiations, and hefty fees. You can't just sell a piece of your house if you need quick cash. Stocks win hands down for flexibility and speed. Real estate is a long-term, locked-in commitment. Let's talk risk. Stocks are volatile. Market crashes can wipe out half your portfolio in months. Picking the wrong stock can be disastrous, which is why diversification through index funds is key. Real estate risk is different. It's about bad tenants, costly repairs, or local downturns. Your property won't drop 20% overnight, but a single issue can hit you hard. Real estate is less volatile, but risk is concentrated in one asset. Stocks are emotionally tough, but diversified. Real estate is hands-on and personal. Both have risks. You just have to choose which you're more comfortable with. How much do you need to start? With stocks, you can begin with just a few dollars. Fractional shares and zero commission apps make it easy for anyone. Real estate is a different story. You'll need tens of thousands for a down payment, closing costs, and a cash reserve. For most, saving $50,000 or more is a huge hurdle. Stocks are accessible to everyone, anytime. Real estate requires serious upfront capital and planning. That's a major barrier for new investors. Passive income, everyone's dream. Stocks pay dividends, small, steady, and truly hands-off. You can reinvest or spend them, and it's all automatic. Real estate offers rental income, which can be much higher, but it's rarely truly passive. You're the landlord, handling repairs, vacancies, and management headaches. You can hire a property manager, but that cuts into your profits. Dividends are effortless. Rental income is rewarding, but comes with work. Know what kind of passive you're really after. So, which wins? Stocks or real estate? The truth: it depends on you. Stocks offer liquidity, low entry, and hands-off growth, but with volatility. Real estate gives you leverage, cash flow, and a tangible asset, but needs more money and effort. Your best strategy might be a mix: index funds for growth, real estate for cash flow. Think about returns, liquidity, risk, capital, and passive income, and what fits your life. Drop a comment. Are you team stock market or team real estate? Thanks for watching.